Everybody, this is Rob Kientz with the Freedom Report. This is your gold and silver analysis for September 12th, 2024. It's a Thursday. I'm recording this about 3 p.m. Central Time for Thursday night on the channel. We usually do it at 6:30 p.m. Central Time. And we're going to roll through real quick the gold chart, the silver chart, talk a little bit about gold and silver ETFs, talk about BIS swaps, which I haven't covered in a long time, and tell you what's going on there and likely how the BIS is getting involved in the industrial markets here in the United States. So without further ado, let's dive right into it. So going back to the gold chart, I've showed quite a few times. This is a long-term chart over about 90-ish, no, about 100 years, it looks like. And basically in 71, Nixon took us off the gold standard. 74, we had the new Commodities Act. And that's when gold really started trading as a commodity where it wasn't a fixed price to the dollar because we're no longer on that dollar gold standard. And price fluctuated. Then, of course, you see leading up to the financial crisis, we had an all-time high of about 1900. It came down, came back up in 20 during the shutdowns, got to a new all-time high. And then you had like a cup and handle pattern, kind of went up and down over that, was it about 11, 12-year time frame. And then after completing the handle part of the cup and handle, shot straight up. So we're at gold here right now. Let's look and see what gold price is at the moment. I like to look at gold price, even though there's a bit of a delay in gold prices pricing. It's very accurate and easier to read than the charts. And whenever the internet decides it wants to come up, we'll show you that in a minute. I think it got to about 25.60 today. Let's see what it's trading at today. Gold price doesn't want to load. So the current gold price, 25.57 according to TradingView. Good enough. New all-time high today. I've talked about technical analysis. I've talked about Fibonacci's. I've talked about trends and all that kind of thing. The technical analysis side is just looking at the chart after everything's happened. So all of the fundamentals and individual pricing decisions and derivative trade is all wrapped up into data points on this chart. And when you look at the chart and you do technical analysis, what you're trying to do then is extrapolate, from that chart, what you think is going to happen next. In other words, all the decisions that went into making the gold price, you extrapolate the next step. And I said that we had a breakout earlier. I said that we probably would in 2024 because of volatility of markets. We'll hit new all-time highs in gold. We've done it probably 5 or 6 times this year. We're sitting up in the mid 2500s, and gold is running and is continuing to run. And if you look like on a shorter term chart, let's see if we can get this down to like a 5-year chart. You can see it's almost straight up. It has some peaks and valleys there, but it's in that last little Fibonacci. What is a Fibonacci? I basically took the low price from when it was released from the gold standard till the high, the previous high that happened in 2020, as a result of the shutdowns. And we had gold spike then, silver spike then as well, hit 30, and they tried to bring it back down. And I took I drew a line from here to here. And the Fibonacci is basically just a mathematical concept. It basically just, it was an Italian mathematician, I think, that came up with it. And essentially is just saying, it's kind of like standard deviations in math. If you remember your statistics class, you're basically saying based on the range of data, if it goes to here, that's a breakout. If it stays in here, it's a range. And if it comes down here, it's a breakout the other way. It's a breakout downward, or it's a crash, if you will. Well, this range for about 50 years is what I graph these Fibonacci's at. And if you look at the Fibonacci's and you get to the blue, that's the breakout. That's the last Fibonacci. That's the top part. Once it hits into that top part, that's where you call a breakout. Why? Because essentially you're trading above the range and another, say, standard deviation or standard level beyond that, to where you're like, okay, now I'm in a bull cycle, because not only do we match the price we had before, but I went a whole nother layer above that. That's all a Fibonacci is. So we've got the breakout there. We're going to go look at the charts. As of, it looks like the data is as of this morning. So we'll say yesterday's data, 513,000 contracts, a very robust market. Overall, on physical deliveries, we only had 21 because there's not a lot in the current September contract. There's only 95 open. Most of the contracts are in December. So the next big delivery month that you'll see is probably going to be December. Now, there are a fair amount of contracts in November, so you'll get some delivery there. I'm sorry, in October. You'll get some delivery in October, but the big deliveries are expected to come in December. You see all of these sort of off market exchanges, the clear ports, the block trades, and the trade after settlements. those are where people are trying to do sort of OTC type transactions or a block transaction, or at the end of the day, there's a close and you say, okay, we're going to use that close price. It's not moving around, and we're going to enter a trade that goes on to the next day's trading exchange. That's what all of those are. And it indicates people don't want to deal with the price volatility, and they also don't want to deal with the market makers kind of pushing that market around. They want to agree on a price with their partner outside of that volatility, outside of that control of the bullion banks. And these have been spiking up, and I've been pointing it out over and over because it indicates that there's not as much gold on, or liquid gold on the market as people need. And also they don't like the pricing every day because of the volatility. The EFPs are where you take a contract from the US and you go over to the UK and you say, okay, I want an over the counter trade. Those are elevated, have been elevated the last few years on both gold and silver. And overall, that's what we're looking at in the data. It just symbolizes to me, people want the gold and they're going after it any way they can get it, essentially. I just look at the settlements tab just to show you the pricing. This is where the price is determined for the October contract and for the December contract. Those are the two main contracts that are trading right now. You can see that it was down as of Wednesday. Tuesday's data, it was up $10. Monday's data, it was up 8. So overall, the trend is up and gold is going up. And this is where your price is determined. This basically determines a spot. You could say it's also in line with the trade in London, although COMEX tends to be a little bit cheaper than the rest of the market. So what you're going to see in the United States is close to the settlement you're going to see here on this derivative market. Going over to GLD, GLD is an ETF, an exchange traded fund. People that own shares in exchange traded fund, if they're not an authorized participant and they don't own at least 50,000 shares, they cannot get physical delivery. So if you're just a regular retail guy and you're throwing money in this, you're not going to get the physical gold. It just gives you exposure to the price. It's another type of derivative. Now, they're supposed to have the gold backing this up, but if you read the prospectus, I was going to say syllabus, not in class. If you read the prospectus, then basically it tells you they don't necessarily have to have it one-to-one match at all times. There's different ways in which they can get around that. So in any case, you may not have all the gold backing that up at the point at which you make the trade. They try to kind of even that up as they go along, but there are discrepancies between the price or the inflows of money into GLD and also SLV on the silver side and what they actually have. And again, you're not getting it out. So this is just basically a derivative of the gold in an ETF format that people can access if they want to do it on their phone or through their Schwab account or whatever the case may be. So you look here and all the green bars are gold inflows. You see more gold inflows than outflows into the ETFs. So that's a signal that retail is wanting gold and they're waking up just a bit and getting some exposure to gold, even though they're not going to get access to the physical. All right, on to gold swaps. There's a really good article on goldseek.com by Robert Lambourne. And I'm basically going to summarize this and take a look at the reporting that he's showing us. What is a swap? The BIS swap. BIS is a bank for international settlements. They're the top of the central bank food chain, if you will. They put out the policy for the central banks. Central banks can choose to or not to follow, but generally the Western ones do. Some of the Eastern ones kind of take some of that guidance. But the BIS is sort of the master bank for the central banks, at least the Western central banks for sure. And they're an influence on the other central banks around the world as well. And so the BIS is doing swaps. What's a gold swap? Well, money comes in, gold goes out, the gold goes out, and it could be used to satisfy trade. Robert is saying in his article, because the BIS has been doing this for a while, and here's a table of the gold swaps all the way back to when they started. I think it was like in 2010. He didn't have the 2010 data, but I think it started in 2010 during the last financial crisis when gold shot up. The BIS started basically taking cash and giving gold to use. And Robert thinks it's being used to settle gold on the COMEX and the exchanges to keep liquidity up. Because when you see the amount of gold that's on COMEX, most of that's not in a liquid form. It's owned privately. It's sitting in a depository, but the owners are not giving it up for trade on the actual exchange because they own it. It's theirs. And so there's been this thought that the liquidity is a lot less than the total gold reserves. And you look at that at the registered category of gold on the COMEX, and here's the eligible, which is privately owned. And then on top of that, you have a little smaller part that's registered. And that registered piece is a little thin sliver. That's your liquid gold. And he thinks that the BIS is doing this for the Fed. It's the most evidence basically as he goes through the reporting, which I'll show you here in a minute, that the Fed is basically exchanging cash for gold. They're taking that gold swap and they're putting it out into the market to satisfy that need for gold to make sure that gold price doesn't spike due to physical demand on the COMEX. Hopefully all of that made sense. So he's saying here that it is possible to estimate based upon these two reports, the current BIS report and the annual that came out in March, or that has through March 31 data, it came out in April. He's saying that the gold swaps undertaken by the BIS at month end, this would be August, is 157 tons at August 31st. This is the highest level since May 31, 2023, and compares to an estimate of 116 tons in June 30th and an estimate of 148 tons in June 31. So the swaps have increased during June and July by 41 tons. If you look, here's the August number, 157, July 148, June 116. So this is basically this year. 117 tons of BIS swaps in January, 68 in February, 70. Let me blow this up so you guys can see. I realize it's a bit small. Okay, 117 in January, 68 in February, 72 in March, 78 in April, 109 in May, 116 in June, 148 in July, 157 in August. The BIS would do it with a central bank or potentially a bullion bank, but it looks like it's probably to satisfy Western gold demand based upon his analysis. You can read this analysis at GoldSeek if you want. I just wanted to walk through the data for you. And this could be providing extra liquidity to those exchanges so that they don't run out of liquid gold, which is a lot less than the overall gold supply number that they tell you about. Now, if you look at this is the annual report as of 30th of March, 2024, the total, it says here, included in gold banking assets is SDR 3.878.1 million. That's in SDRs, not dollars, of gold that the bank holds in connection with gold swap contracts. And that amounts to 72 tons. So that's the number that he got as of March. So if you go down here to March, it's 72 tons. And then he's adding up what's in the other documents, including 157 in August. So if you look at August, what you do is you look at gold and gold loans. You look at the difference between from March, the total, to August. The difference is what they've done from March to August. And it's about 9,400 SDR millions, which he is estimating, if you go to the article, if you swap that out for tons, is the 157 tons. So he's getting his data from the BIS. He's doing a mathematical calculation and figuring out based on the gold price how much they're swapping out, and he gets to this table. All of this is expected to provide liquidity for the Western markets because there's not enough gold going on. That's the only really reason the BIS would get involved with either the bullion banks or the central banks. If you want, read his article. It's very interesting, but that's what the swap is. The BIS swaps provide liquidity to the market to prevent a physical shortage and therefore a gold price breakout, essentially. All right, moving on to silver. Here is the silver chart. I did the same thing. I graphed it out since basically the Commodities Act allowed silver to trade as a commodity in the early 70s. And essentially you have a bigger cup and handle pattern, but you don't really have that big breakout yet. Now this cup and handle pattern goes to 80. You remember in 80, 79 leading up to 80 had high interest rates. Paul Volcker had to issue, had to raise interest rates to something like right at 19%. The Fed did, and so it brought interest rates down. Well, interest rates are going up. Gold and silver both went up, and they hit highs. And silver touched on $50 in 1980. Now, inflation adjusted, that'd be something like $150 to $200 now in today's dollars. So we're expecting that if you got the equivalent price of silver now to what it was, inflation adjusted back in 1980, last time we had that big inflation, the silver would be sitting at 150 to 200. That might be a low end target for when the U.S. starts to have high inflation again. We started to have high inflation in the last year and a half. It's tamped down a little bit, but we think we're back in a reinflation because inflation numbers are ticking up. And so that's bullish for the silver price overall. But silver hasn't broken out. If you look at Fibonacci's, again, just taking the top and low price over a 50-year price range, since silver was allowed to kind of break free of money in the 60s and allowed to trade as a commodity about the same time as gold. And when silver started being demanded as an actual industrial commodity more than just money, you put a top and a bottom, and the Fibonacci's are just mathematical levels. Think of like standard deviations in statistics, where you have that little, hump chart that we all do. That basically Fibonacci is a similar concept, and it hasn't broken out. It's sitting in these middle Fibonacci levels, these middle levels. Silver still range trading, and it hasn't had its breakout. Gold has had its breakout. You can see clearly gold is broken out, and that's a clear sign technically that gold is outside of its trading range. Silver has not followed just yet. I put a tweet out today that I thought silver was price suppressed more by the Western side, and then I think the Eastern central banks are focusing on gold because gold is going to back up the banking system, and the East is buying it, and the gold is moving from west to east. You know, the BIS is getting it through swaps. It goes to the exchange. The Eastern powers are taking it off of the exchange from London and COMEX, and that's what's happening. So all that gold's going west to east, and that's causing an increase in the overall gold price and in the derivative markets as those prices are being bid up on contracts, because the traders see what's happening to the deliveries and they see what's happening to the demand on the paper side. And so gold has broken out, but I think the West is suppressing silver because they need it. They need it for the military. They need it for the internet. They need it for a lot of things. Silver is the most critical mineral right now on the planet, in my belief, because a lot of things stop working if we don't have it. So I think they're keeping silver down because of its commodity nature, whereas the rest of the world's bidding up gold because of its monetary nature. Silver will eventually follow gold, even though it's not doing it now. But you can see the path. It started to spike up. You've got a nice little spike. Now, if it gets to this next to last Fibonacci level, which is 0.786, and then it gets to 1, which is on parity with, you know, the previous all-time high, then you'll have a breakout. It's not there yet, but silver is getting a little bit more frothy and a little bit more interesting as well. As we go to the CME Group website and look at the COMEX trading data on silver, overall, you had 130,000 contracts close as of yesterday. You only had 13 deliveries. Again, small delivery month. The next big delivery month, you could have a little bit in October, and then you can have a lot in December. So expect December, you probably get the last big amount of silver deliveries off of the COMEX, off of the industrial market. It's got some clear ports. It's got some EFPs over to London. It's got some trade after settlements. So silver is not as much being physically demanded at the level that gold is, because I think the Eastern powers and other powers around the world are coming to the Western market to grab that gold. Right now, silver is just normal industrial trade. It's not monetary trade. So that's why when you look at the gold chart, you go over here to volume and OI, you've got much more of these block trades, clear ports, EFPs, trade after settlements than you do in silver. Silver hasn't been grabbed as a monetary asset just yet. It's just normal commodities trade. So that's how you know silver hasn't broken out. When you look at all these data points and put the picture together, silver hasn't broken out. Let's go to the ETFs and retail demand. There was a nice little retail demand back in July. After that, it's kind of faded out. And if you add up the negatives and the positives, it's about even. So again, not a lot of retail demand, investment demand for silver. When you add that up and you look at the lower amount of deliveries, the lower amount of EFPs, and all these other settlements, people aren't just trying to grab the silver for monetary purposes off the exchange, and they're not putting a lot into the ETFs. Overall, it's up over the year for the ETFs, but not as much as you may think. So silver hasn't caught that bid just yet. Gold's going to go first. You can see it in the data. You can see it up here. You can see it right here. You can see it in the price. Gold's popped, silver hasn't. Silver story is usually after gold. We're not quite to the crisis moment where everybody freaks out about the dollar and about all that stuff, but you see people more and more bullish on gold and silver this year because of the election, the geopolitical tensions that we have, and the looming downturn that all the retailers like Home Depot, Lowe's, Dollar General, dollar stores, all of them are saying that we're going to have in the economy. So I expect the second, after starting about October, November is when silver may start getting a little bit more frothy. It may start to follow gold just a little bit, depending on what happens here in the US politically and what happens geopolitically with the wars. And then if we continue to get more economic bad news, that's just going to buoy silver a little bit more. I wanted to give you a really interesting perspective on silver from Visual Capitalist. Visual Capitalist always has these wonderful visuals I love. And we've talked in the past when we looked at the Silver Institute's reporting and Metal Focus about the lack of silver demand to supply. It's been short, almost 800 million, 900 million ounces over the last 4 years, meaning the mines aren't putting out as much as we're demanding in the economy. And that's why the levels on the exchanges are coming, a physical that's above ground and in bar or coin form is coming down. Even though retail hasn't caught on to silver, it's still being used more in industry for commercial purposes. And that demand is a supply deficit. In 2023 alone, the silver market experienced a 15% supply deficit. 759 million ounces from 2021 to 2024. The silver market is expected to reach a cumulative deficit of 759 million ounces. The deficit is in the black and white bars right there. As we go down, silver is essential in new technologies. We've got solar demand, which is increasing. The expected for 2024 projected is a lot more, about another 40, tons 40 million ounces more than we had in 2023, which is about 60, almost 69, 70 million ounces more than we had in 2022. So you can see that solar demand is increasing the demand for silver. We talked about last week how the new silver batteries expect to be used in EV production are going to potentially use all the silver over the next 10 to 15 years at current production numbers. So that means over the next 10 to 15 years, because of EV and solar and all those government mandated programs, we've got to pull at least 30, 40, 50% more silver out of the ground to break even on the increased demand. In fact, we may have to double it. Depending on how much these green technologies grab silver, we may have to double our silver production over the next 10 to 15 years. It's using a lot of technologies, electrical vehicles, silver nanoparticles, iPhones, semiconductors, LiDAR technology, AI, all of this stuff. 70% of silver is mined as a byproduct of gold, copper, and other metals. You guys know that. You watch the program all the time. 28.3% comes from primary silver mines. And here's the different mines. 30.8% comes from lead zinc mines as a byproduct. 13.7% from gold mines, and about a little over a quarter from copper mines. Top primary silver deposits, Polymetal Resources has this much outcrop silver, Dolly Varden, Vizsla, BlackRock. Some of these are in the Western Hemisphere, which are friendly to the United States. So the United States should be able to get its silver where it needs it for strategic purposes. And I fully expect maybe the US government to start doing deals with silver producers at some point if we reach a shortage. So that's a nice little infographic on silver and the deficit, 59 million ounces. And it shows you the increasing need for EV. And we know the increasing need, for solar, and we know the increasing need from EV. We go to commitment of traders. I do this one just to show you what's going on with gold and silver. This is silver as of September 3rd. That's the latest data. Remember, it's always about a week to 10 days short. And here's the silver information. I always do the bullion banks. They dropped some shorts, which allowed silver price to rise. Why is silver price rising now? They dropped shorts. They got rid of their short contracts. When you drop short pressure, it allows the price to rise. The biggest shorters are the swap dealers. We can tell by this number right here. It's the biggest. And we can tell down here with the 8 largest traders short are 57% of all shorts on the market. So the bullion banks control the shorting for gold and silver, the majority of it. Not all of it, not a plurality, but a majority of it. Same thing with gold. We look at the bullion banks. They dropped 9,410 shorts. 9,410. What do you think the bullion banks, who are the market makers in the derivative markets, think is going to happen to gold and silver the rest of the year? It's going to go up. And what are we seeing in the charts? It's going up. New all-time high today in gold. And as we look at silver, it's going up too. They both have vertical lines. Now, silver hasn't reached its big breakout, but it's got a vertical line, and you can see that in the data. And we know why it's shortages due to industrial demand on silver and monetary demand on gold. Gold's flowing west to east. We keep seeing that with all of these different mechanisms of trading on the market, and silver is just being gobbled up by everybody for industrial use. And that's basically what's going on. That's going to be your gold and silver report. I got it in under 25 minutes. I'm going to try to get it in 10 to 15, depending on the data I got, but I had a lot of good data today. So this is going to go about 24-ish minutes, which is not too bad. Stay tuned. Sometime this weekend, probably Saturday, I'll release a report on employment and immigration and how those two interact. I've been promising that for about 2 weeks now. We're going to try to record it tomorrow and get it out by Friday night or Saturday, so you guys can take a look at that. And then we'll be back next Tuesday as normal for the economic report. I think I'm going to do economic reports Tuesday, gold Thursday, something else on the weekends, and that's going to be the way we do it. Now, if you'll notice, the last year to year and a half, I haven't had as much content on the channel as I typically had. Now we're getting back to what I had a year and a half, 2 years ago, with 2 to 3 reports a week on a regular basis, because I think things are more interesting and it's worthy of doing it. So we're going to do that. And thanks everybody for participating. Until next time, this is Rob with the Freedom Report.